Hi, today we're going to talk about a merchandising company. A merchandising company sells merchandise to make a profit. So we have a couple of new accounts. The first account is merchandise inventory. Merchandise inventory is a current asset with a debit balance, and that represents the stuff that you will sell. Our next account is sales. Sales is a revenue account with a credit balance, and that represents any revenue you earn from sales. Cost of merchandise sold. That is an expense account with a debit balance, and that represents the cost of what you sold. Delivery expense. That's an expense account with a debit balance, and it is used if the seller pays for shipping. Customer refunds payable is a liability account with a credit balance, and that is a liability that you set up in case you need to give refunds to customers. We also have a new calculation. It's called gross profit. The formula for gross profit is sales minus the cost of goods sold equals gross profit. The income statement for a merchandising company will include a section at the top for gross profit. Also, the balance sheet will include a current asset called inventory. Now let's look at the journal entries. Here's the information for our problem at the top of the screen. We're going to purchase inventory worth $10,000. The credit terms are we can save 2% in 10 days, or the full amount is due in 30 days. Credit terms are given for sales on account. Also, a few days later, we're going to return $2,000 worth of the merchandise. The discount amount is 2%. I know that because this says 210 slash or comma in 30. So I'm going to save 2%. That means that the amount I actually pay is going to be 98%. Notice here that it says always assume that the buyer will take advantage of the discount. So now let's make the journal entry to purchase merchandise inventory. We're going to have a debit to merchandise inventory when we buy inventory, and we'll have a credit to accounts payable. But we need to calculate the amount. So we're going to find the discounted amount of $10,000. There are a couple of different ways you can do that. You can calculate the 2% discount, which is $200, subtract that out, and the amount you're going to pay is $9,800. Another way you can do that is you know that you'll actually pay the difference between 100% and 2%, which is 98%. So you can actually key in your calculator $10,000 times 0.98, and that's going to give you $9,800. Now we're going to assume that we decide to return some of this inventory. And so what we'll do is we'll return inventory, meaning that we don't have to pay for that amount that we returned. And we're going to credit merchandise inventory because we're going to send some merchandise inventory back. So before I figure out the number that goes here, let's go ahead and fill in our T accounts from the first journal entry. There was a debit to merchandise inventory of $9,800 and a credit to accounts payable for $9,800. That means that now we have an asset, inventory, worth $9,800, but we also have a liability because we have to pay for that of $9,800. When we return inventory and we have taken advantage of a discount, then we have to figure out, well, how much did we pay for that $2,000 worth of inventory? So the amount of the return will actually be given to you in the problem, but we have to figure out the price that we paid for that. What was our cost? Well, we saved 2%, so our cost is 98% of $2,000. So I'm going to scroll down here to show you how I calculated that. I returned $2,000 retail price less my discount means that I return $1,960 worth of inventory. So I would debit accounts payable 1960, and I would credit merchandise inventory 1960. When I debit accounts payable for 1960, that means that I now owe less. I will credit merchandise inventory for 1960 because now I have less inventory. The last journal entry you need to know is how to pay off your bill. But before we pay off the bill, we have to calculate the balance of what we owe. So I'm going to go ahead and total out these T accounts. So I'll draw a line on each T account, and then I'll figure out the balance for merchandise inventory, which is $9,800 minus $1,960. And the balance now for accounts payable is $9,800 minus $1,960 because I returned some of the inventory. And anytime you make a return, you don't have to pay for that portion. So it looks like the amount that is due is $7,840. Whenever I pay off a liability, I debit the liability and I credit cash for the amount that is due, which is $7,840. Once I debit accounts payable for $7,840, now my balance will be zero for that account. So that zeroes out that accounts payable. I have paid off what I owe. I still have inventory, and then also if I had a T account for cash, my cash would have gone down by this amount, but I didn't create that here. So I hope this helps you understand the journal entries for the buyer in a merchandising company.